Sneaky, sneaky inflation and how it hurts your portfolio. Ugh. Anyways, this is my boys Cliff Asness and the AQR. 25 years, dude. I can't believe I've been in this business since 1998, so that's 26 years. But man, I remember following Cliff back in the early aughts. 25 years, damn. Tick tock, tick tock, and then it's gonna go like this: tick tock, tick tock. The older you get, tick tock, tick tock. Time's a wasting, baby. Time's a wasting. All right, so let's see what Cliff said. And I don't know who wrote this article, but inflation and tax efficiency. Inflation hurts investors' bottom line even more than you realize. Their inflation and taxes are linked in two ways. The first is straightforward. It's called bracket creep. The idea is that the tax bracket cutoffs adjust upwards with inflation, but at a lag. So if your income this year moved up 1 for inflation, in real terms, you're no better off than last year. From a tax perspective, that nominal increase gets taxed at your highest marginal tax rate. The result, your overall effective tax rate has gone up. So it's actually, that's kind of hard to understand. So let me kind of try to explain it like this. So let's say you make $100 this year, 2023. I mean last year, but we're just using this year. $100 in 2023. All right. 2024, you make $105. All right. So you're up 5% in income. What used to cost you $100 in 2023, if a 5% inflation rate kicks in, now it costs you 105. All right, so your income kept up with inflation, and that's net of everything, tax and all that. So you're no better off. You're not worse off, you're no better off. However, this is what I wish you would explain a little bit differently, but I'm going to give my best. You're taxed this year based on the last year's inflation adjustments. All right, so that 105 is being taxed from that extra $5 of income that you made. That $105 of income is being taxed based on the inflation rate that we had in 2023. But we still have 2024 inflation to contend with. I hope that makes sense. Because what happens is when they come out with the 2024 tax brackets, it's based on 2023 inflation numbers. But our income is based on 2024 numbers. So basically, we're almost, I don't want to say paying double inflation, but we have to pay, and we are literally, inflation is a real-time thing, a real-time issue. The price of that dozen eggs is paying today. It's not based on last year. Last year's already been baked into it. It's based today. So the $105 and $105 of inflation, that might equal out. But the facts are that $105 we have to pay for the inflation from last year in our tax brackets, but we still have to pay it for today's prices. That's the lag. The 2024 tax brackets are based on last year's numbers. And yet in 2024, we're paying today's inflation. Hope that makes sense. I don't think it does, but hopefully it does. That's a challenge. Let's keep going. The second way is more subtle. For an investment portfolio, inflation can matter much more. To illustrate with an example, suppose you buy a stock for $100 and sell it a year later for $110. This gain, $10, is taxed at the long-term rate, which will soon to be here 23.8%, because the 0, 15, and 20% of the long-term capital gains, but the 3.8 is your net investment income tax, NIIT. And remember, those are not indexed for inflation, just like Social Security taxation is not indexed for inflation. And until Trump came around, the AMT, the alternative minimum tax, the Democrats, I don't know, the Republicans too. I mean, my goodness. But they get you, man. They don't index this stuff for inflation, basically drawing more and more people in. I would call that tax bracket creep. All right, so what's happening is more and more people are going to be subject to NIIT. The NIT, remember nitpicking? If you had lice, you had to, you're picking nits. You know what I'm saying? I remember when I was in Catholic school in 6th and 7th grade in Cathedral School in Portland, Maine. And every now and again, they'd find some kid with lice. And this is back in the days when Catholic schools took poor kids. You know, they don't do that anymore, apparently. It's crazy. But anyway, so you got a lot of poor kids. And, of course, you insinuate lice with poor. It's not that, but now, I mean, it's just not. But that's what you insinuate before. So what they do is they line us all up in our little Catholic uniforms. I remember this like it was yesterday. And Sister Aunt Selma, she'd take, I think it was like a straw, and she'd look through your hair. And if you did not have lice, you could go back to the classroom. If you did have lice, you'd go over there. I remember sitting there because I was a poor kid thinking, please, for the love of God, don't let me have lice. Don't let me have lice. I don't want to go over there and be mocked. It's kind of like during the days when I was at Peaks Island School, you had free lunch. So what they do is they line you up. If memory serves, I'm sure this is true, but I can't remember for sure. Anyway, so I think the kids who had their own lunch would just go right to the tables to sit. The kids who paid for lunch would get in the front, and the kids who had free lunch would get in the back. You know what I'm saying? And there'd always be like, all right, free lunch starts here. You know, the rich kids who paid for lunch would be up front. And I always remember being in the back and finally get my lunch and I have to go up and all my friends are already kind of sitting down. You're just like, why adults? Why? Adults are stupid, man, when it comes to dealing with children. Trauma, dude. Come on, just basic stuff. And then like everyone get into groups, and you're like, if you're a kid and you're like kind of shy or you don't really have that many friends, you're new in school, you're like, everyone just get in a group, find a partner. You're like, what? Never do find a partner. It's stupid. All right, let's keep going back. Anyway, so here we got a $2.38 tax bill because we sold the stock for 110 that we bought more than a year earlier for 100. So we got a $10 gain. We got 23.8% effective tax rate on this because of long-term capital gains plus a net investment income tax. But inflation was over 4% that year. In real terms, the investor only made $6. All right. So again, in this case, we have $100 in 2023. In 2024, we have 110. In 2023, what costs $100 now costs 104. So net of inflation, we don't have $10, we have $6. Our real return isn't 10, our real return is 6. That makes sense? So we have 100 stock, sold it for 110. What costs $100 now costs 104. So we have a gross return of 10%, but a real return net of inflation of only 6. But guess what? We're still paying that 23.8% on that 10. As if we actually made the money, and we did not. And so when you factor out that 23.8% on a 10, it's a $2.38 tax, a 23.8% tax bill. But when you factor in that $2.38 tax bill on the net we made, 6, it's a 39.7% effective tax rate. Almost doubled our tax rate. Isn't that crazy? Because we're actually paying taxes on the $10, but we're only keeping 6 net of inflation. But we're still paying tax on the 10. Again, bracket creep. And he shows us here. So say we got a portfolio return of 5%, and we got 3% inflation rate. All right, so let's just do this for simplicity. Actually, to make it simple, let's keep it at 10. That'll make it easier for me. Right here. Yeah, let's do 5. That'll be 5. So we started the year with $100 and what costs $100. So we got $100 for what our stock, and we got $100 what it costs to live. We made $105 in stocks. So we made a 5% return on stocks. So our $100 went to 105. The cost of inflation went from 100 for a 3% inflation to 103. So now our stocks went from 100 to 105. The cost of goods went from 100 to 103. So we made $5 gross, for which we have to pay tax on, but we only made $2 net. So we're paying 23.8% on that $5. All right, 23.8. Let me get my calculator here. Hold on a second. So that's $1.19 is what we're paying in taxes on that $5 gain. Unfortunately, though, that's $1 and $1.19. So we take our $5, subtract 1.19, we're left with $2.38. All right, so what happens here is, $5 subtract 1.19, what the hell? We're left with $3.81, excuse me, $3.81. That's what we're left with. But what happened here, we had a 3% inflation rate. So minus $3, we're left with 81 cents. That's what we're left with. So the $5 gain, we got to pay tax on 5, and then we get the rest after inflation. We're left with 81 cents. That's it. And so in this case, our effective tax rate jumped up from 23.8 to 59.5 because we're only left with 81 cents on a $5 gain. Oops, I lost it. Pretty crazy. That's the sneakiness of tax. And now, if this is an IRA, it doesn't matter because everything comes out as ordinary income, and the ordinary income tax brackets are adjusted for inflation. All right, so we don't have to worry about that. So again, other than the lag I talked about, the point 1 is that we're paying taxes today on inflation from last year, but yet we're still got to deal with inflation today. That's a problem. And another thing about the Roth, of course, is the Roth, there is no taxes whatsoever. So we just have to, inflation will just eat into net returns. Now, you got to remember, too, the capital gain tax brackets are indexed for inflation as well. So it's not all, there is something to say about there is indexing for inflation on capital gains as well as marginal income tax, for sure. But at the end of the day, if you're still in a 23.8 or 15% tax bracket, you know what I'm saying, net, this is 100% true. So one of the things you got to do is just more tax efficiency. And I talk about that in my new course, Everything You Need to Know About Investing, that I'll release here shortly. I'm just waiting for a couple more pieces of feedback on that. But everything you need to know about investing, we do talk about tax efficiency. Because one of the things we don't want is we don't want a lot of income generated in our post-tax accounts and our brokerage accounts. We don't want a lot of income. We don't want bonds there. By and large, whenever time I do a video, someone says, you said, look, everyone's situation is different. Generally speaking, I'd say the vast majority of the time, you don't want income derived in your brokerage accounts. All right. You want long-term capital gains if you have any. And that's why index funds just work, man. Index funds, because there basically are no long-term capital gains or very, very little. And your dividends in an index fund is very, very low right now. So very little dividend income, very little long-term capital gains. And I use the example of stocks and taxes with a lady I had. I'm not going to share with you here too much, but she got hammered in taxes. She was just not prepared. She was not prepared. All right. God bless. Let me know what you think down below. We'll see you guys.